It finally happened. Silver didn't just rise, it detonated. On the largest metals exchange in Asia, the Shanghai Futures Exchange, silver surged past $100 per ounce, equivalent in a single explosive session. Not in some thin overnight trade, not in a quiet corner of the market, in the heart of Asia's physical metals hub. And while the Western spot price hovered in the high 80s, Shanghai screamed triple digits, a 13% move in one day. That's not volatility, that's pressure releasing. And if you understand what that means, you understand something much bigger is unfolding beneath the surface. Here's the problem nobody wants to confront. The silver market is fractured. On one side, you have the international spot price, largely discovered in London and New York through futures contracts and paper derivatives. That's the number financial media flashes across screens. That's the price portfolio managers reference. That's the quote most investors see. On the other side, you have the physical market, the real metal changing hands, shipped in vaults, melted, refined, delivered to industrial buyers. And right now, those two markets are telling two completely different stories. When Shanghai trades silver at a 10-15% premium above international spot, it signals stress. It means buyers inside China are willing to pay more than anyone else in the world to secure physical supply. That doesn't happen in a balanced market. It happens when supply is tight and demand is urgent. Now add fuel to that tension. During a week-long closure for Lunar New Year, Chinese traders were sidelined while global silver prices climbed sharply. Scrap prices inside China rose aggressively. Trade tensions escalated. Futures inventories in the US continued to drain. When Shanghai reopened, all that pent-up demand hit at once. The result? A violent repricing. But the deeper issue isn't just the price jump. It's what that jump implies. If refiners, traders, and institutional buyers see $102 equivalent in Shanghai and $88 in London, what's the rational move? Ship metal east, redirect inventory, follow the premium. That creates a vacuum effect. Physical ounces flow toward the highest bidder, leaving less available in Western vaults. And when inventories fall while open futures contracts remain elevated, the system becomes fragile. This is how structural cracks form. For decades, silver has been considered a secondary metal, overshadowed by gold, overlooked by mainstream finance, treated as volatile and unpredictable. But structural shortages don't care about reputation. They care about supply and demand math, and the math is tightening. If the physical market continues to demand metal at triple-digit prices while the paper market lags behind, something eventually has to give. Either premiums collapse or international prices catch up. History shows those gaps rarely close gently. Now here's where the story gets even more interesting. Despite silver's dramatic rise over the past year, from deep pullbacks to fresh highs, speculative participation remains historically low. Hedge funds, momentum traders, retail frenzy, they're largely absent. That's unusual. In past silver rallies, speculative money flooded in early, positioning surged, media attention amplified the move. Eventually, momentum buying turned strong rallies into full-blown manias. This time, the physical market moved first. Managed money long positions in U.S. futures markets sit near multi-decade lows relative to price levels. Think about that. Years ago, when silver traded near $11, speculative longs were higher than they are today, near $88.90. That tells us something crucial. This rally has not been driven by hot money. It's been driven by industrial demand, strategic accumulation, and tight supply, which raises a powerful question. What happens when speculative capital finally notices? When silver crosses $100, not just in Shanghai, but globally? When financial news outlets start running segments? When headlines flash triple digits? When social media latches onto the move? Does momentum accelerate? History suggests yes. In 2011, silver surged toward $50 as speculative positioning exploded. Futures contracts ballooned, retail investors piled in, leverage amplified gains, and volatility. Now imagine that kind of participation layered on top of an already tight physical market. Futures contracts represent 5,000 ounces each. Tens of thousands of new contracts equate to hundreds of millions of ounces in synthetic exposure. If that paper demand collides with physical scarcity, the system strains. That's where the concept of a delivery squeeze enters the conversation. As delivery months approach, holders of expiring contracts must choose, roll forward, or stand for delivery. If physical premiums remain elevated, taking delivery and arbitraging regional price differences becomes attractive. Even a small percentage choosing delivery can stress warehouse inventories. And inventories have been declining, which leads to the most important question of all. Are we witnessing the early stages of a structural repricing, where physical demand forces paper markets higher? If so, the real move may not have started yet. To understand why silver exploding past triple digits in Shanghai matters, you have to zoom out from the headline and step into how this market actually functions beneath the surface. Silver is not just a shiny metal investor stack in safes. It is a critical industrial input woven into the infrastructure of the modern world. Every solar panel requires it. Every advanced circuit board depends on it. Medical equipment, electric vehicles, high-efficiency batteries, telecommunications grids, all of them rely on silver's unmatched electrical conductivity. Unlike gold, which is mostly stored and rarely consumed, silver is constantly used, dispersed, and in many cases unrecoverable at scale. That distinction changes everything. When demand rises for gold, the above-ground stockpile acts as a buffer. When demand rises for silver, much of the supply has to come from fresh mining output or recycled scrap. And both of those sources have limits. Mining silver is not like flipping a switch. The majority of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. That means silver output is often tied to the economics of entirely different commodities. Even if silver doubles in price, a copper mine won't instantly double production just to extract more silver. The infrastructure, labor, permits, and geological constraints don't allow it. New standalone silver mines take years, often close to a decade, to move from discovery to production. Environmental approvals, financing, feasibility studies, construction timelines, all of it stretches far beyond the time frame of a price spike. So when demand surges unexpectedly, supply cannot immediately respond. Now place that rigid supply structure against the backdrop of accelerating global demand. Over the past decade, renewable energy initiatives have expanded dramatically. Governments across Asia, Europe, and North America have committed billions to solar infrastructure. Solar manufacturers require silver paste for photovoltaic cells. There is currently no scalable substitute that matches silver's efficiency without sacrificing performance. As solar adoption increases, silver demand becomes embedded in national energy strategies. At the same time, technology manufacturers continue locking in long-term supply agreements. Large electronics firms quietly secure metal through contracts that rarely make headlines. These agreements remove ounces from the open market before they ever reach public exchanges. Then there's the investment layer. Exchange-traded products, bullion dealers, and institutional portfolios all represent additional channels of demand. Unlike industrial buyers, investors can pause or accelerate purchases based on sentiment. But when both industrial demand and investment demand align, pressure builds quickly. That pressure is what makes regional price dislocations so important. When the Shanghai Futures Exchange trades silver at a meaningful premium to Western benchmarks, it reflects localized scarcity. China operates within its own regulatory ecosystem. Capital controls, import restrictions, and export policies can isolate its domestic market from global supply flows. If domestic buyers inside China face tight supply, whether due to policy decisions, logistical delays, or surging industrial demand, prices can detach from London or New York. That detachment is not theoretical. It is a real signal that physical buyers are bidding aggressively for available ounces. But arbitrage is never frictionless. In theory, traders could buy silver at $88 internationally and sell at $102 in Shanghai. In practice, shipping, insurance, customs clearance, regulatory approval, and time delays complicate that process. If export rules limit outbound shipments, the premium persists longer than simple math would suggest. While physical markets adjust, futures markets operate on leverage and expectations. Each silver futures contract represents 5,000 ounces. When traders build large positions, they are making directional bets rather than immediately exchanging physical metal. As delivery months approach, contract holders must either roll their position forward or stand for delivery. If a significant number choose delivery during a period of tight physical supply, warehouse inventories decline. When inventories drop consistently, confidence in the ease of delivery weakens. That's when volatility tends to increase. Historically, silver rallies unfold in phases. The first phase is accumulation. Prices grind higher quietly. Industrial demand strengthens. Inventory data tightens. Media coverage remains minimal. Speculators stay cautious. The second phase is recognition. Technical breakouts occur. Momentum traders begin to notice. Open interest rises. Headlines start appearing in niche financial outlets. The third phase is acceleration. Mainstream media picks up the story. Retail investors flood in. Leverage expands. Price swings grow larger, both upward and downward. What makes the current environment intriguing is that the physical market appears strong, while speculative positioning remains relatively subdued. That suggests the rally has not yet entered full acceleration. Another layer to consider is psychology. Silver carries a reputation for volatility. It has experienced dramatic spikes followed by sharp collapses in past cycles. Many institutional investors remember those drawdowns and remain cautious. That caution limits early participation, but it also creates room for rapid inflows if sentiment shifts. Media attention often acts as a catalyst. When prices cross symbolic thresholds, round numbers that grab attention, narratives shift. Portfolio managers who previously ignored the metal begin fielding questions from clients. Analysts publish new forecasts. Television segments debate whether the move is sustainable. This feedback loop can amplify price action. However, volatility cuts both ways. Silver is known for swift pullbacks that shake out overconfident participants. A rally driven purely by leverage tends to unwind violently. A rally supported by physical tightness tends to correct but resume its trajectory if supply remains constrained. The key variable is balance. If mining output stabilizes and industrial demand softens, premiums fade and prices consolidate. If renewable mandates continue accelerating and strategic accumulation persists, supply deficits deepen. Right now, the pieces form a complex puzzle. Constrained supply growth, embedded industrial demand, regional premiums, modest speculative exposure, and shifting global trade dynamics. Individually, none guarantee explosive upside. Collectively, they describe a market entering transition. Transitions are rarely smooth. They involve repricing, recalibration, and emotional swings. Participants anchored to old price ranges struggle to adjust. New buyers hesitate until confirmation appears. Sellers question whether pullbacks represent opportunity or warning. Silver has reached a moment where physical signals are growing louder than paper assumptions. Whether that moment evolves into sustained triple-digit global pricing depends on how these forces interact in the months ahead. But one thing is clear, the story is no longer just about a price chart. It is about structural supply limits colliding with modern industrial necessity, and markets rarely ignore that collision for long. Here rests the real shift taking place, and an S bigger than a single price spike. When silver trades above $100 equivalent on the Shanghai Futures Exchange, while international spot lags far behind, it signals something deeper than volatility. It signals that the center of gravity in price discovery may be shifting from paper markets to physical demand. For decades, global silver pricing has largely been anchored in Western futures exchanges, primarily London and New York. These markets trade enormous volumes of contracts, representing silver that often never changes hands physically. Most contracts are rolled forward or settled in cash. That system works smoothly when physical supply is abundant and confidence in delivery remains strong. But when physical markets start paying persistent premiums, double-digit premiums, over futures benchmarks, it exposes a crack in that structure. A premium of 2-3% can be dismissed as temporary imbalance. Even 5% can occur during tight shipping conditions. But sustained premiums of 10 or 15% reflect urgency. They reflect buyers who are willing to pay significantly more to secure real metal rather than rely on financial exposure. That distinction matters, because silver is not just an investment vehicle. It is a critical industrial material. Solar manufacturers, electronics producers, and advanced technology firms cannot substitute it easily. If they need supply, they must secure it regardless of short-term price fluctuations. This creates a structural dynamic. Industrial demand does not disappear simply because prices rise. Now combine that with limited supply elasticity. Silver mining output cannot scale quickly. Most production is tied to byproduct mining of other metals, meaning silver supply does not respond directly to price increases. New mines take years to develop. Recycling helps, but scrap flows also have limits. When supply growth is slow and demand remains embedded in infrastructure expansion, price pressure builds gradually, then releases suddenly. The second key element in this reveal is speculative positioning. Historically, major silver manias occurred when leveraged money flooded into the market. Hedge funds, momentum traders, and retail investors piled into futures contracts, driving open interest dramatically higher. That leverage amplified price swings. What makes the current environment unusual is that speculative participation remains relatively subdued compared to past peaks. That suggests the rally has not yet been fueled by broad momentum chasing. In simple terms, the hot money hasn't fully arrived. That leaves room for acceleration. If global headlines begin highlighting triple-digit silver prices, not just regionally but internationally, investor psychology can shift quickly. Portfolio managers who previously ignored the metal may begin allocating capital. Retail traders may view it as the next breakout. Exchange-traded products may see inflows. When new speculative demand layers on top of already tight physical supply, volatility tends to intensify, often to the upside. The third component is inventory flow. Warehouse data has shown notable outflows in recent periods. While inventories remain substantial in absolute terms, trends matter more than totals. Consistent drawdowns during periods of strong demand suggest metal is moving from tradable vault systems into long-term custody or industrial consumption. When inventories decline while futures open interest remains high, sensitivity increases. Even small shifts in delivery behavior can amplify price movement. The broader implication is this. The physical market may be asserting influence over derivative pricing rather than passively following it. If regional buyers continue paying premiums and global supply remains constrained, international spot prices must eventually adjust upward to restore balance. Markets dislike persistent arbitrage gaps. Does that guarantee immediate global $100 silver? No. Markets can consolidate. Premiums can narrow temporarily. Headlines can trigger corrections, but the structure has changed. Silver is no longer behaving like a sleepy secondary precious metal drifting behind gold. It is behaving like a strategic industrial asset facing tightening supply conditions. And when a market transitions from being overlooked to being strategically important, repricing tends to be decisive. The real reveal isn't just that silver crossed $100 in one exchange. It matters is that the physical market may be signaling a new equilibrium, one where paper benchmarks must catch up to real-world demand. And when that adjustment happens, it rarely happens quietly. Now I want to hear from you. When you saw the premium between Shanghai and international spot, what was your first reaction? Surprise? Skepticism? Confirmation of what you suspected? Do you think this gap narrows through falling premiums or rising global prices? Are we early in a structural shift or witnessing a temporary imbalance? If you followed silver for years, you know how emotional this market can be. It punishes overconfidence and rewards patience. But it also offers extraordinary upside when conditions align. Drop your perspective below. Are industrial dynamics the main driver? Is speculative capital the missing ingredient? Or is geopolitical strategy playing a bigger role than we realize? And if global spot breaks $100 decisively, do you expect momentum to accelerate or volatility to shake out late entrants? Your insights matter. Markets are collective psychology layered on top of supply and demand. Understanding sentiment is as important as analyzing data. Let's discuss it openly and critically. We began with a single number, $100 in Shanghai. But that number is more than a milestone. It's a signal that regional demand can diverge from global benchmarks, a signal that physical markets may be tightening, a signal that speculative participation hasn't yet peaked. If the premium fades quickly, this becomes a brief anomaly. If it persists, it becomes the opening chapter of something much larger. Watch the spread between Shanghai and Western spot prices over the coming days. Watch futures open interest into delivery months. Watch inventory flows. Those metrics will tell the story before headlines do. Because when structural shifts happen in commodities, they start quietly, in vault reports, warehouse data, and regional exchanges, long before they dominate front pages. Silver crossing $100 in Asia may not be the finale. It may be the first crack in a system repricing a strategic metal. And if that's true, today won't be remembered as the peak. It will be remembered as the moment the physical market spoke first.